it gives me great pleasure to introduce our guest presenter this morning. A member of the Keiretsu Forum's founder chapter since 2002, author of the Keiretsu Forum's Due Diligence Process Handbook, chairman of the Keiretsu Forum's Bay Area and International Due Diligence Committees, he is also leading the launch of Keiretsu Squared, a premier business accelerator. He has reviewed and provided guidance to hundreds of companies and is an active private equity investor and entrepreneur. Please help me welcome our presenter this morning, Michael Gralnick. Michael?
Good morning. A pleasure to be here, and thank you for having me. I wanted to mention why Breakaway is so important and why I'm really happy to be here. We live when raising companies, money for companies and funding companies, be they small or large, in a world of an interesting paradox. The bulk of the money out there comes from lenders, comes from debt, comes from financial institutions. Virtually all private equity investors who make investments, they're looking for the 1 in 100 shot of something that's going to have a big liquidity event. Let me give you a concrete example. A couple of years ago, I was in Palo Alto looking for a place to eat. I wandered into a restaurant on its opening day. I don't even remember the concept, the theme of the restaurant. It was something health-related, highly differentiated, and I was fascinated. I asked to speak with the owner. He came up to me. I'm always curious about people. I asked him, how did you get into the restaurant business? He said, well, I was in management at a big franchised restaurant company, and I really wanted to start my own restaurant. So I pried a little. Well, okay, what level of management were you in? Well, I was a chief operating officer at McDonald's. Well, okay, how did he end up? This was his passion, to start a small restaurant. If he walked into a bank, they'd look at his balance sheet for the bank, and they'd say, you need to write the check yourself. We can't lend to you. So what Breakaway is doing can really solve a real big problem. My intent for today is to get through some, well, I'd love to say it's exciting, but at least interesting, some material about due diligence as quickly as possible and then get into a discussion. Please don't save the questions for last minute. Write them down. What I'm looking to discuss is this. Where did communications break down during the due diligence process, and why? So how did I end up speaking about something like due diligence instead of becoming an authority on something like, baseball or more interesting? Just a series of twists and turns. When I talk about my background, I like to talk about why and how I came to do what I do rather than everything that came in between. And that goes back to high school. When I was a kid, I was born to a father who was a Depression-era kid. He grew up in the Depression, and he taught me 3 different things that were kind of in conflict with each other, but created a theme. The first was you need to be a professional, be a lawyer, a doctor, in case there are economic problems. You can hang out your shingle. The second was be a business owner. What I saw him doing was not being a professional. It was being a doctor who ran a hospital and had 60, 70, sometimes more employees and ran his business from Florida. And the third and the most important lesson was you have an obligation to make a difference in the world, to make the world a better place. So somewhere along the lines when I got out of law school, I said, well, I'm near Silicon Valley, and maybe the way you make a difference in the world is not being on Capitol Hill, it's being in Silicon Valley. I hope I don't offend anyone, but the joke I like to use is you can probably make a bigger difference in the world being able to buy a U.S. senator than be one. And one thing led to the next. I ended up in a small broker-dealer, consulting, raising money for companies. Somebody from that same high school that taught me a lot of my values approached me. He had a very innovative, differentiated business model, brought me into my first startup company. Some years later, I ended up working right-hand man, chief operating officer in a startup with somebody that most people in the Silicon Valley would consider in a venture capital community genius level about where technology is. And what I ultimately learned is about myself is that I've got this ability to cut through things in highly innovative, disruptive companies and kind of cut to the chase. And then I ended up in Keiretsu Forum, and I ended up on both sides of the table as an investor and as an entrepreneur on both sides of that table, and somehow or another ended up writing the due diligence process handbook, which Keiretsu members around the world use. So let me take just quick less than a minute on Keiretsu Forum for those who are not familiar. It was started back in 2000. Keiretsu Forum has 1,500 plus members all around the world, private equity investors, and it has migrated recently from just being about connecting capital and great companies to taking companies from cradle to greatness. So there's several parts of the Keiretsu Forum ecosystem. Keiretsu Academy gives a short series of courses that help prepare companies to present effectively. Keiretsu Forum funds companies. Keiretsu Global, with its now I think 38 chapters around the world on multiple continents, syndicates investments. Keiretsu Capital is a fund through which our members, many of them invest, and then we select best of breed deals that have gained traction among the members, and the fund will co-invest with members. And then Keiretsu Squared, which I'm leading a launch of now, is where we build best of breed investment opportunities. It's not an accelerator. You'll hear more about it in coming months. It's a group of experts that come in and work hands-on with people to actually, the mission is pretty simple, radically accelerate the path to market growth and liquidity of companies that have high potential. With that background in mind, let's get to the topic. So here's the theme. When you were dating, whichever gender you are, how often did someone at that first date say to you, you know, I'm not interested for this reason, and so I'm not going to go to the second date? Well, that didn't happen to me. I think I can remember two people who actually were that straight to me. Most people just didn't call back. And then there's kind of a second theme, and that's the more people are interested in you at the same time, the more interesting you are to other people. And that has a lot to do with the timing of how you implement or execute the due diligence process. Now, before actually going into due diligence per se, I want to start by talking about the most important lessons I've learned in business and as an entrepreneur, and also as an investor, watching companies as they did or did not succeed. So we're here, whatever religious beliefs you have about God, we are here as human beings to grow and develop. And I have noticed that many people bring the life lessons they're having as humans into the businesses they're starting. So let me give you a couple of examples. And I'm not going to mention any names, but I can cite a new beverage company that didn't make it, that was a great, highly differentiated beverage company. It was led by somebody who had built a company who, if anybody on this call walked into a grocery store, they would recognize that brand name, in partnership with a young first-time entrepreneur who at some point decided she was more capable than he was. And before long, there was a proxy fight for control of the company while the company was raising its Series B funding and going into distribution conversations with mainstream grocers. Well, obviously that made it a little difficult to complete that financing. So the solution was, okay, let's bring in somebody else. Let's have this Series C, I think it was, or Series B funder, bring in another expert who had also built a publicly traded beverage company, who not as many people, but most people would go into a grocery store and recognize the products. That person tried to move the first person out. Eventually, you can see what happened. The company didn't make it. I've seen examples of CEOs from major publicly traded companies come into early stage entrepreneurial ventures and bail because of their self-image concern, There are lots of these examples. My point here in this drawn out example is to succeed in business and to succeed in capital raising, you need to keep your eye on the end game. And you need to have others that see your blind spots as both human beings and as business decision makers and have them on your team. And this is actually, before I move on, relevant to due diligence, and here's why. Due diligence, as we'll discuss, is not just a checklist of items to review. It's about assessing how leaders are going to respond on the playing field as they make decisions and grow companies. It's about the leaders. So let's turn to the most important lesson specifically about raising capital and capitalizing companies. Think outside the box. Find things and ways that you can grow the same business you're planning on growing highly strategically with less capital. That's what investors want. They want risk reduction. Prepare for due diligence before presenting. And we'll get into that in more detail. And then primarily what I'm hoping to discuss a lot today is the process of thinking about the questions we miss. Whenever an investor asks a question, there's a concern underlying it. And the key to success in due diligence, in back-leading investors towards making investment decisions, is catching what those concerns are. Not what's asked, but what really is the concern. So here's the investor's perspective. I want to just be silent for 10 seconds and actually let people look at this slide and digest it instead of just reading it. So due diligence is perceived as a checklist, but it's not just a checklist. It, as I said a moment ago, is a thought process. It's sharing wisdom and sharing insights among investors to help assess what is likely to happen in the future. So we're going to discuss that theme in 4 parts today. First is, what does the investor presentation have to do with due diligence, and how do we use it to kickstart the process? The second is how to prepare effectively beforehand. The third is how to implement the process in a way that increases the chances of raising more capital. And finally, identifying what the real concerns are underneath stated questions, which brings me to a reminder, please start thinking about questions and putting them in the screen now for Kim to look through. Questions, what we want to discuss, hopefully in an active way coming up, is, again, where did communications break down and why? Ultimate objective, again, is to practice this thought process. The content, if you're looking for a checklist, if you're looking for that information, we'll talk about it a little, but it's all in the due diligence process handbook, which is located at the Keiretsu Forum site and also on the iBook store if you're an iPad or iPhone user. So kickstarting the due diligence process. Common wisdom says the investment presentation is about getting people interested, getting them to be interested in a second date. In practice, the due diligence process begins before the presentation and at the presentation. It's an opportunity when you get into that presentation to think through your business and proactively defend against, to preempt potential objections, to preempt the concerns that are sitting there in the minds of your audience as they listen. This is not a new theme. They taught it in law school, they teach it in business school, they teach it in debating classes. Any argument you make, somewhere in the middle, usually about halfway or 2/3 between your opening and your closing argument, is defending against the likely counter arguments. Well, investor presentations have certain formats and content on the slides, but within your discussion points should be defending against the concerns. So let me give you a couple of examples that make the point. These 3 items are discussed in every presentation. What's your market size? Most people, they hear that, they say, what's your total addressable market? What's really in the mind of the person in the audience asking that question is, well, what's your beachhead market? What's the first sub-customer group that when you go after them with your product, you can get 60 or 70% of that market share. So we know your company is going to be sustainable. So we know it's cash flow positive. So we know that you'll then have sustainable revenue and then produce other follow-on products. The question is, what's the sub-market, not the total addressable market? You've got to show the financial projections. What are your financial projections? The real concern there is how effectively are you going to use the investment capital we give you to get to revenue faster and need less capital? What's your valuation? That means how much dilution am I going to endure? That means how much more capital am I going to need? That means am I investing at a price that will produce a return? So take a look. One other thing in terms of preparing, take a look within the Keiretsu Forum Due Diligence Process Handbook. It's going to be in an updated version of the iBook. It's now in the PDF form. And there's a Kickstarter document in one of the appendices. Going through those questions beforehand will be helpful towards the thought process and towards being prepared in advance. I'm not going to talk about the investor presentation format in detail. That's largely a different subject. At the same time, I'm keeping the slide in here so that it's there as a reference. So you can be, if you're not already familiar with this, I think ideal timing of content, go back to it in the future. That said, since I'm saying the investor presentation is the first part of due diligence, I want to give a couple of key pointers on presenting. I assure you, I've both given a few and heard a few, many. And the most important, so let's run through a couple of these. The most important thing is your command presence. It's not getting all the content right. The one most important thing about a presentation is people are looking at you and they're saying, how's that person going to behave in front of customers? How are they going to behave in front of future investors? They're looking for how you handle 2 people or 100 people. The content, I hate to say it, but it's less important, and here's why. Anything you miss from that content, you can find a way to weave in the Q&A session. Second thing, and arguably even more important, is any good presentation should, within the first 15 to 30 seconds, get in there, who do you think is going to acquire your company? In other words, how am I going to get my money out if I invest? And please, never say the word IPO. If you say the word IPO, what happens immediately in the back of an investor's head is that person's not realistic. So few companies get their liquidity from IPOs. That person's not realistic. Number 3, make crystal clear what your product is clearly. If they don't get it, that audience is going to be sitting there thinking through, trying to interpret, and they're not going to hear your next 5 slides. I talked about the beachhead market and verticals a moment ago. And possibly the most critical thing is never, never miss a potential competitor. If you're presenting to the Keiretsu Forum in the Bay Area over 3 days, you may be in front of 300 people. All of them have built companies, know companies, have lots of contacts. The odds are that somebody in that audience may have heard of a competitor that you are not aware of. So do your research first. Don't get caught with your pants down. There's a joke in there related to dating somehow, but nonetheless, let's stay focused. So finally, know your exit multiples, know your valuation, and be able to defend your valuation. When you assert a valuation of your company, what it's worth, how much your stock should be bought for right now, people want to know where you came up with that, and they want to know it's negotiable. Which brings us to preparing properly. I know it would be simple to just say, let's create a slide with 10 bullet points, but it's all in the handbook. It's all in the handbook. Please just go review it. What you're trying to do when you put your content up in a due diligence deal room, which we'll get to in a moment, or a due diligence binder, is you're trying to address the verification level due diligence. Yes, due diligence is primarily about a thought process, but there is stuff that needs to be verified. And those things fall into two key categories. They fall into understanding and verifying the competitive landscape, the market, the industry, where this company can go in that area and that market. And the second is making sure that what you said in your presentation is accurate. So that doesn't mean itemize every last thing, because you might be giving them things they don't know, but it does mean make the investor's life easier. If you go through the deliverable section in stage 2 of the handbook, there is a top 10 list there. Look at that list and put out there the content that addresses those questions. And of course, look through all the appendices to the handbook. Okay, so here is the robust part beyond just the verification process of getting everything ready. You want to build a comprehensive deal room. You want to take all the things in the handbook that are relevant to your company, and you want to have it out there ready online before your investor presentation. I vividly remember to this day, among all the companies I've seen and all the companies that have come through Keiretsu Forum, one company that pointed us towards a deal room, and on that website was everything segmented, categorized, and I wasn't alone in looking at that and saying that person has their act together. And this goes to never getting a second chance to make a first impression. When I looked at that deal room, I said, okay, that person is going to be prepared when it's time to raise the Series B or the Series C. So I'm at less risk because they're more likely to be able to do that and succeed when it comes to completing due diligence with follow-on investors. Okay, develop a potential list of questions that you're going to face. Think it through. Think through what the questions are unique to your company. Prepare to discuss industry exit multiples, worst case scenarios, dilution scenarios, how you developed your valuation. It's going to come up in every due diligence process. Switching gears just a little bit, one of the most leveraged things people can do and be prepared for is to document future interest. I've seen a lot of people come into presentations and say, but we've talked to these 10 people, these companies that are interested. Well, if you go and you get those companies to give some letter of intent, it can be completely conditional. It can give 9 out of 10 ways, I'm exaggerating a little bit, that they can get out of that commitment. The result is going to increase your credibility. Effectively, raising customers precedes raising capital. And on a related note, don't just prepare a financial model in your company, prepare a financial model for your customers' companies. If you can show investors that if a company pays $50,000 for your product, one of your customers pays that, they're going to save $1.5 million over 3 years. And then if you can go show them that they can finance that $50,000, as an investor, I'm going to look at that and say, okay, that person is going to be able to make a compelling case to customers. So as we switch into the theme of accelerating the due diligence process, the point that I'm trying to get to here is real simple. You're about to begin an engagement process with multiple investors. You're about to start your dating life. And the more people you're engaged with, the more synergies you can build, the more interest you're going to develop. If you have your questions ready, if you have your deal room ready, you're not going to get interrupted by spending 3 hours writing out questions and answers. You're going to have that list of 100 potential responses. You're going to look at the email from the investor, and you're going to be able to tweak that within an hour and a half of writing instead of 8 hours and get back on the phone. And that method of doing things leads to success in closing funding. It brings people together at the same time. If you have people together at the same time, it increases your negotiating power. There's going to be a key question that many investors are going to ask. If we don't invest, who's going to invest next? Who else is at the table? If you've got 3 other people interested in investing, suddenly there's a little bit more of an urgency. And if you've got everything prepared, then you are better able to, you're better able to keep the process moving. Which brings us to the underlying concerns. If I was to give a theme of all underlying concerns, there's a concern underneath every question, and the odds are that underneath every concern that's under every question is, how is risk going to be reduced? Private equity investing is about increasing the odds of getting a high ROI, higher than you would in other investment classes, with the risk being losing all your money. It's that simple. And a related risk to that is, will you get a return, but there'll be so much dilution that it's going to be a nominal return. You might as well have invested somewhere else. So this is really how that ROI formula translates. Investors are looking at ROI as the price they invest at, followed by what happens between here and there. What is the valuation at each subsequent financing, and how much the stock is cost then, which determines the dilution, taken up to what is likely exit comparable. So it's from here to there, and investors are looking back from the future, from what the exit multiple is. Now that ROI calculation, possible or probable ROI calculation, translates directly into 3 parts of a due diligence equation. What's the company really achieved? What happened to comparable companies financially if they succeeded? And where might you be overly optimistic, meaning what might happen which might create more dilution than you're anticipating? Again, most important question is, how are you going to reduce the risk of dilution? How are you going to respond to unforeseen challenges? How are you going to increase customer demand faster than you use capital? How are you going to raise follow-on capital if necessary and not leave investors caught having to put in even more money? So before we go into open discussion, if you haven't put questions in now, please do so. Again, we're looking for a theme. If we're going to have a good discussion here, the theme is, where did things break down and why? So let's do a quick recap. 6 points that we've been getting at here. Number 1, prepare that due diligence binder, create a deal room. And by the way, Keiretsu Forum and a lot of angel investment groups right now use Proceeder, and put everything you can that's going to help the investors move faster in that deal room. Prepare all your written answers to probable questions unique to you and your company before you engage with investors. Get feedback from seasoned investors and experts about, what really is the concern underlying that question. Build your preemptive answers into the concerns, about those concerns, into your presentation. Establish written, documented customer demand, even if it's contingent and conditional, before raising capital. And then remember, at the root of most all questions is this: how are you going to reduce the risk of dilution? How are you going to move the company forward faster when you run into the unexpected? Which brings us to open discussion. What about your company and your current status are the most likely underlying concerns to address in due diligence? What strategic alternatives can you use to reduce risk? And what are we about to learn from each other's questions? Kim, back to you. What are we talking about?
Well, Michael, thank you so much. That was really informative. In fact, we've got a couple of questions right now, and then there are a theme of questions that really drill down to what is identifying the concern under the question. So first of all, I wanted to report back that thank you for all of you who indicated whether or not you were an investor or an entrepreneur raising capital. So pretty heavily slanted towards companies raising capital. So about 90% of the participants online today are raising capital. So great information for them. Michael, the first question here. Let's talk about what is an acceptable response for the question, how will you reduce the risk of dilution? Is there such a thing?
Well, it would be a set of different things, but my first response to that is how much interest from customers can you show? And my second response would be, is there a faster way that reduces less capital? Let me give you one other example I might have mentioned but I don't think I did when I was talking about lessons up front. There was somebody that I worked with who was very successful, very young, raised lots of money, taking companies public, and his customary way of dealing with things was, I am going to be able to raise more capital. Well, what if you can't raise more capital? So what happened was this person ran into a series of mini crises instead of finding ways to grow the company on less capital. So that's an example which leads to this answer, which is come up with several ways to build the company out of your garage, bootstrapped, and then show the investor those ways so they know what your fallback plan is. I think a slight variation of that theme would be, let's say, what happens if you don't raise any capital? Who are you going to have to lay off? And a slight variation of that theme is, are you going to go the distance on your own with no capital? So it's a long-winded response to the question, but the simple answer is, show me 5 different alternative approaches you think you can use.
Excellent, excellent. Going back to your suggestion to create a list of questions to be able to respond to, would you suggest that business owners or entrepreneurs include in part of the due diligence a Q&A, or just to keep that more as a reference for conversational meetings?
Well, both. I mean, generally speaking, all investor presentations have 50% of the time allotted to Q&A, or certainly 30%. So you're not going to need to suggest the questions for Q&A. They're going to be there. You just need to anticipate what they're going to be in advance. Does that answer the question?
Okay. Yeah. Just I didn't. Just kind of a curious in terms of, should you list the most like FAQs? Here are the top 10 questions we know we're going to get, and here's how we respond to them. But
I would say not. I would say not to put it up as a slide, but the act of having it ready will allow you to weave it into your discussion.
Okay, excellent. A couple of questions related to intellectual property. So how would you interpret this question, or the concern behind this question? What reserves do you have for IP protection or prosecution? That seems kind of grim, but what reserves do you have for IP protection or prosecution? What's the question or concern behind that?
Well, it's 2 things. One is, do you recognize how expensive it is in terms of your use of proceeds to actually deal with intellectual property if it's challenged? But really, if I hear that question, what I'm hearing is, do you realize that IP is not an end-all and be-all? Is there another way? Should your strategy be, how fast can you take this to market and build customer adoption, even if your IP becomes meaningless? So that's how I would interpret that question.
If your IP is proprietary, in other words, it's the company's kind of secret sauce, and the company will not be filing for a patent, not sure why they wouldn't do that, but if they chose not to, how long before someone else might attempt to file? So that's kind of the
And that would be basically the question is, you're dealing with something that's uncontrollable. You're dealing with an unknown. So you'd be saying, well, if somebody else files, could there be a risk of us having to pay a license fee to them or us being derailed? Us, when I say us, obviously it becomes a marriage. It becomes a marriage of investors and company leadership. So us now becomes the company and all its stakeholders. So what would the risk of us becoming subject to the whims of their company be? Now, that said, IP doesn't get filed overnight, and if you talk to an IP attorney, there's nuances in terms of well, you were out there first, so they can't really derail you. But the question is, what alternatives are there?
Excellent. Well, I think that that was our last question, Michael. I think we're just going to move on to some final comments and some takeaways for today's event. And that will be, Chair?
Yeah, definitely. There are two things. I've stressed it a number of times, but the content is in the handbook. If you go to keiretsuforum.com, either in the Tips to Present section, Entrepreneur Tips to Present, or the Investor Due Diligence subtab, you can download the handbook in PDF form. There's a lot of content in there. And on a related note, there is one piece of content that is not in there because the Kaufman Foundation, for some reason, wouldn't give us permission to keep it in there or put it in there. But in the PDF form and in the nearly soon-to-be updated iBook form in the recommended reading section are some great articles on valuation by some highly established angel investors. Look that up. And then Keiretsu Squared's company overview form, which is the root of the Keiretsu Squared program that we're going to be launching, which is a 3-month program that brings in experts on both conference calls and on individual work in sequence over 3 months. That program revolves around a company overview which has clear sets of objectives that needs to be met, of needs analysis. And if everybody on this call has no interaction whatsoever with Keiretsu Squared or Keiretsu Form in the future, I still encourage you to go download that form, which is on the Keiretsu Squared subsection of the Keiretsu Form website, and go through those questions. It's a team alignment exercise. It's designed to have your lead investors and your entire executive team analyze what are the key needs of the company. So take a look at those resources and don't hesitate to contact me at the information on the screen.
Excellent.
That is also there as a reference for people looking at this PowerPoint deck in the future. Those 2 slides are taken out of one of the appendices to the handbook. That's a consolidated list of the bullet point questions that investors should be reviewing when reporting back to other investors.
At the end of each session, I like to add my own few things to remember. And here they are. First, defend the negative. Anticipate those objections to help you get closer to funding. Secondly, exude confidence. If you don't believe in yourself, your abilities, and your company, it's hard for others to believe in you. And finally, prepare. There is no substitution for preparation. And for those of you who missed our May webinar, How to Pitch Your Deal to Investors, presented by Che Voigt of the North Bay Angels, I encourage you to review it at breakawayfunding.com/events/video and audio library. Again, breakawayfunding.com/events/video and audio library. This presentation dovetails nicely into Michael's comments about the two-part due diligence, investor presentations, and other due diligence materials. And speaking of Michael, I would like to take a moment again to thank him for sharing with us the framework and the importance of due diligence. And truly, what are the real concerns behind prospective investor questions? If you have any additional questions for Michael, his contact information is available in this presentation. We will be sending you the post-webinar link of today's session so you may review it at your leisure.